Equity mutual funds. You've probably heard the term thrown around, right? But what are they, really? Well, today we're going to cut right through all the jargon. We'll show you how they work, how they're all sorted, and most importantly, what you should actually expect if you decide to jump in. So let's get to it.
So let me ask you something. You want to invest in the stock market, right? You want a piece of all those big, innovative companies out there? But let's be real, buying each stock one by one would take forever and a ton of money. Well, that exact problem is why equity mutual funds were invented in the first place.
You know, the easiest way to think about it is like this. It's a giant investment potluck. You and thousands of other people all chip in some money. Then a professional, the fund manager, takes that huge pool of cash and goes shopping, buying a massive, diverse portfolio of stocks. You get a piece of everything without having to do any of the research or individual buying yourself.
Now here's a key rule you should know. For a fund to even call itself an equity fund, it has to follow a strict guideline from the market regulator, SEBI. And that rule is at least 65% of all the money in that fund has to be invested in stocks. It's kind of like a guarantee that the fund is actually doing what it says on the tin.
Okay, but when you first look at all the different funds out there, it can feel overwhelming. It's like staring at a massive supermarket aisle with thousands of choices. So to make sense of it all, you first have to understand how they're organized on the shelf. And really, it all comes down to two main ways of sorting them.
First, funds are categorized by the size of the companies they invest in. Are they big, medium, or small? That's what we call market capitalization. And second, they're sorted by the strategy or philosophy the fund manager uses to pick which stocks to buy. Let's tackle company size first because it's the most straightforward.
Market capitalization. It sounds complicated, but it's really just a fancy way of saying how big a company is. Large caps are your giants, the huge, well-known companies. Mid caps are the ones that are already pretty established, but still have a lot of room to grow. And then you have small caps. These are the up-and-comers, the smaller businesses that could potentially become the giants of tomorrow.
All right, so now we know the basic organizing principles. Let's actually look at the menu and check out some of the most common types of funds you're going to come across.
Okay, this difference right here is super important. A multi-cap fund manager has a very strict recipe to follow. They have to invest at least 25% in large cap, 25% in mid cap, and 25% in small cap companies. No exceptions. A flexi-cap manager, on the other hand, has a ton of freedom. If they believe mid caps are the place to be right now, they can put a huge chunk of the fund's money there. So it's really a choice between built-in discipline and managerial freedom.
Now let's talk about those investing styles. Growth funds are all about finding companies that are poised to grow way faster than everyone else. It's high octane, which can mean big rewards, but also bigger risks. Value funds are kind of the opposite. The managers are like bargain hunters, looking for really solid companies that, for whatever reason, the market just isn't appreciating right now. They're trying to buy great businesses on sale.
And if you take that value investing idea to the extreme, you get contra funds. These managers are true contrarians. They aren't just looking for a deal. They're actively digging for great companies that almost everyone else has given up on, betting that they'll make a huge comeback. As you can imagine, this one takes a whole lot of patience.
And finally, maybe you're not just looking for growth. Maybe you want your investments to generate some income. That's where dividend yield funds come in. They invest in big, stable, established companies that have a long history of sharing their profits directly with investors. It's kind of like getting a regular little paycheck from your portfolio.
Okay, we've seen the different types of funds, we know how they're organized. But now it is time for the most important part of this whole discussion. What actually happens after you invest? We need to have a serious reality check about returns, risk, and, well, patience.
This is it, isn't it? The million-dollar question. Everybody wants to know how much money they can make. But the truth is, the answer is not a simple number. The stock market is a roller coaster, and believe me, equity funds are buckled into that front seat.
I want you to just look at these numbers. They tell a powerful story. In years like 2021 and 2023, one of these indexes delivered eye-popping returns over 50%. But then look at the other years. In 2022, it was down almost 9%. And in a crisis year like 2008, it was a bloodbath, down almost 70%. The key thing to see here is that returns are never ever a smooth, straight line. There will be good years, and there will be bad years.
And this quote from the National Institute of Securities Markets just hammers that point home. It says it all. If you're looking to get rich quick, this is not the place to be. Investing in stocks through mutual funds is a long-term game. It's about having the patience to ride out those tough years to benefit from the good ones.
So, with all this in mind, how in the world do you choose? Well, this is where it gets personal. The right fund for somebody else might be the wrong one for you. It all depends on your answers to these questions. How much risk can you really handle? How long do you plan to stay invested? What are you actually saving for? There's no single magic answer here. It's about what fits your life. So there you have it. That's the basic toolkit for understanding equity mutual funds. You know what they are, the different types they come in, and the volatile truth about how they perform. The next step isn't about finding some secret, perfect fund. It's about thinking and deciding what you want your money to achieve for you. Now you have the tools. So, how are you going to build your future?